Well, it has been quite a while since we have had this much improvement in rates, so I'm excited to get into it. Let's talk about it. We are seeing interest rates at 7+ month lows today, y'all. The Fed did something the Fed hasn't done in a really long time yesterday. They helped us with regard to interest rates. Today is Thursday, the 14th of December. I hope you're doing well. Here are the numbers, y'all. We are at 6.62 in the Mortgage News Daily tracking poll. We were at 7.05 a week ago, so we're 3/8 of a point, if not a little bit better than we were 7 days ago. 30 days ago, y'all, we were at 7.4%. So we've seen rates improve almost 7/8 of a point in the last 30 days, which is a dramatic improvement in rate. So very, very nice gains in the bond market have given us much lower interest rates. What does that mean for a typical buyer? Well, if you're borrowing $500,000 today, you're going to have a payment of $3,200 on it. If you had borrowed that same $500,000 30 days ago, your payment would have been $262 a month higher. What does that translate into? Well, it translates into exactly $40,939 more house today for the same payment that it would have cost you 30 days ago. Just to put it into perspective. That's a dramatic improvement, y'all. That is a very nice increase in affordability in a 4-week period. So very glad to see it. Here's what brought it to us. Number one, Consumer Price Index came in on Tuesday. It did not have any surprises in it. It was very slightly higher on the headline number, but the internals actually showed some promising signs of inflation continuing to ease. The Producer Price Index that came out on Wednesday was actually significantly better than expectations. We saw nice improvements in the Producer Price Index, which is more heavily weighted towards the wholesale side. So good improvements on the inflationary front really took any fire out of the Fed's desire to maintain a hawkish stance. Now, the Fed was not expected to raise rates. They were not expected to cut rates. There was a 100% likelihood that the Fed was going to keep rates steady with their announcement yesterday, and that's what they did. But the all-important statement that the Fed releases really drives how bonds are traded. Now, again, this is where I've explained in the past, and I'll do so again now. The Federal Reserve does not set mortgage rates. What the Federal Reserve does, though, is they do set the tone for trading in the fixed income market, right? Those things that disadvantage bonds in the long term drive investors away, and that pushes yields higher and prices lower. And the reverse is also true. When the Fed becomes more friendly to the long-term outlook of fixed income securities, and you see folks wanting to buy them, and that's what we're seeing. We are seeing renewed demand, 7+ month higher demand for fixed incomes are driving us down into the race that we're seeing today. The Fed indicated, and they refer to this as just penciling it in, a number of the Fed voting members in their meeting yesterday released guidance that they are anticipating a minimum of 3 25 basis point cuts in 2024. Y'all, there were a number of folks that were out there speculating, folks that I really respect, some of the online services that I subscribe to, were suspecting that the Fed might surprise us with kind of a shock bullish statement out of concern that rates have fallen significantly enough to where they're worried about inflation not being sufficiently tamped down. Some were speculating that they would see the Fed take a kind of a renewed stance to say, hey, rates have really improved. We want to reset the stage that there's not going to be any cuts. Well, they didn't do that at all. They came right out with a statement that acknowledged weakness in growth, acknowledged a slowing pace of growth. These were some of the changes in the statement yesterday. They also acknowledged weakness in the labor markets that they're starting to see. So those two components, adding that they're seeing a slowdown in the rate of growth in the economy, talking more about the weakness in the labor market that we've seen in the last couple of employment reports, has led them to pause, especially when you put it in the context of that CPI and PPI coming in as good, if not better than expected. So what does this mean for us in the coming year? Do we sit on our hands and wait for these rate improvements to show up? Well, folks, in large measure, they just did, right? The bond market very much trades based on where they think bonds are headed over the next significant period of time. So a great deal of these cuts that the Fed acknowledged and kind of winked at yesterday that we're likely to see in 2024, we are seeing in today's pricing. So folks should not wait. Again, refinancing is a thing. If rates do get significantly better, then great, we'll refinance them. But if not, they've got a nice little reprieve, $41,000 more purchasing power today than 4 weeks ago. So in any event, the Fed may well be able to take credit for a soft landing, y'all. In other words, having this massive increase in rates over the last 18 months or so without causing a recession. Are they going to engineer that? Well, we will see. We've also got an election cycle coming, y'all, and that's another reason to kind of suspect the Fed is typically friendly to an incumbency, especially one on the side of the aisle that they more likely identify with. So is some of this aiding in that regard? Well, we've seen it in the past, y'all. So that's all I'll say about that. In any event, if you have any questions, feel free to reach out. We're honored to have your referrals. We do mortgages for a living here, y'all. So ring the phone if you have somebody that is interested in getting pre-qualified. I do that usually in less than an hour, folks, and get you a bulletproof approval letter where I go into the details of your borrower to make sure that once we say they're solid, they're 100%. So in any event, give me a shout. Stay blessed, stay safe. We will talk to you next week.